Welcome to the Deep Dive. We're here to cut through the noise and get straight to the core insights from the latest earnings calls.
That's right.
Today we are tearing into Climb Global Solutions, ticker CLMB. Their second quarter 2025 results just dropped.
And yeah, if you saw the headlines, wow, this wasn't just a beat.
No, not at all. It feels like maybe a fundamental shift. They just blew expectations out of the water.
It really was a material surprise, pretty much across the board. I mean, the numbers they released, they signaled such strong operational momentum, the market reacted instantly, even pre-market.
Okay, let's jump right into those headline results then, because the sheer size of the beat really needs emphasis. What were we looking at for EPS? Consensus was around, what, 99 cents?
Yeah, just under $1.
And they delivered. Non-GAAP adjusted EPS came in at a stunning $1.39.
$1.39, that absolutely crushed the 99-cent consensus. I mean, do the math. That's a 40% beat.
A 40% beat on the bottom line. Incredible. But the revenue story might be even wilder.
It really might be. Climb reported $159.3 million in revenue for the quarter.
$159 million. And the high end of the estimates was like $113 million?
Exactly. $113.3 million was the top end of the range. So they didn't just meet it. They, blew past it by a huge margin.
So that top line translates to, what was the year-over-year growth?
An explosive 73% year-over-year revenue increase.
73%. You just don't see that kind of jump often, especially in, IT distribution. It sets a really high bar.
It certainly does.
So for you listening, the big question is, where did that come from? Was this all just buying growth through acquisitions, or is the core business firing on all cylinders?
That's the crucial question, right?
Okay.
And it's why these earnings feel so high quality. It was actually a healthy mix.
Okay.
They saw double-digit organic expansion in the core business. So their existing channels, their existing vendors are really thriving.
Good.
But crucially, they also got the full accretive contribution from the Douglas Stewart Software acquisition, DSS, which, remember, closed late last year, Q3 2024.
Yeah, right.
And DSS specifically added some critical seasonal strength this quarter. It was mostly driven by education customers, making their big buys gearing up for the school year.
Okay, so that makes sense for Q2 timing.
Exactly. So strong organic growth amplified by a very well-timed acquisition that really leaned into that Q2 seasonality.
So it sounds like a perfectly executed strategy, honestly. And that translated directly into this, well, frankly, outsized print. No wonder the market reacted so strongly.
Validated the whole bullish thesis right there.
Okay, let's unpack this a bit more. Let's dive into the mechanics behind that revenue surge. Looking beyond just net revenue, the other metrics seem to back this up.
Oh, absolutely. Gross billings, that's the total value of all the product they sold through for their vendors that jumped 39% year over year. Came in just over $500 million.
$500.6 million in gross billings. Wow.
And adjusted EBITDA, which gives you a good sense of their operating cash flow, that was up 64% year over year, hitting $11.4 million.
Okay, pause there for a second, because the difference is key, right? Gross billings over $500 million. But reported revenue, only $159 million. For anyone maybe less familiar with this distribution model, why the huge gap?
That's just the nature of the distribution game, isn't it? Gross billings is the sticker price, the total value of everything they move for Dell or Microsoft or whoever.
Right.
But Climb's reported revenue, that's just their slice. That's the margin they keep after they pay the vendor back for the actual hardware or the software license.
Gotcha. So the fact that their slice of that massive pie is growing and growing efficiently, that's the real story.
Precisely. And that efficiency point is where it gets really interesting. The quality of these earnings points straight to operating leverage. It looks like the full implementation of their new ERP system, the Enterprise Resource Planning System, is fundamentally paying off.
The ERP rollout, yeah. That was a big investment.
Huge. Think of it like the company's central nervous system, right?
Well,
it connects and automates everything on the back end, finance, logistics, sales ops. And as a direct result, their SG&A sales, general, and admin expenses actually decreased as a percentage of those gross billings. It went from 3.6% down to 3.3%.
Okay, so they handled almost 40% more volume.
Right.
Without a proportional increase in overhead. That's textbook operating leverage.
Textbook definition. They're processing way more business, but the ERP means they don't need to hire nearly as many new people in the back office to handle it. They've basically automated away a chunk of future headcount costs.
And that leverage, that efficiency, that's critical because it should create the margin expansion investors always look for. Did we see that flow through?
We absolutely did. Their effective margin, that's adjusted EBITDA as a percentage of their gross profit, it expanded by a really impressive 600 basis points.
600 basis points. Wow.
Yeah, reached 43.3%. Now, interestingly, the gross profit margin itself as a percentage of gross billings did tick up slightly higher than usual, came in at 5.3%.
Okay, and their normal range is more like?
Usually around 5.0% to 5.1%. Management was actually very clear about this on the call.
Good.
They said that little bump was temporary. It was due to some lumpy higher margin deals landing in Q2. They specifically called out a big order for vast data that got pulled forward from Q3.
Okay. So managing expectations for Q3.
Exactly. They reiterated the long-term gross margin target remains in that 5.0% to 5.1% range. Unless, and this is the important part, unless they significantly layer on more high margin services.
Okay, that services angle is key for later. But first, let's look at the foundation, the balance sheet. How are they fixed for making future moves?
Oh, it looks pristine. Just fantastic shape. We're talking $28.6 million in cash on hand.
Solid. And debt.
Minimal, like $500,000, basically nothing. Plus, they have a $50 million revolving credit facility that's completely undrawn.
So zero drawn on the revolver. That means they have a serious war chest ready to go if they see an opportunity.
A very serious war chest. And it really seems like this management team isn't the type to just, throw that cash around carelessly. They're applying that same kind of discipline we see in their operations to who they even partner with.
Right, that connects the efficiency story back to strategy. They can afford to be picky.
Extremely selective. And what's fascinating is hearing CEO Dale Foster talk about their vendor curation process. He said in Q2, they looked at roughly 50 potential new vendors to add to their line card.
50 potential partners. Right?
And out of those 50, they only advanced 4 out of 50.
Yeah. Wow. That's a remarkable level of strategic patience, isn't it? They're clearly prioritizing quality, high-impact solutions over just adding logos for the sake of breadth.
Absolutely. It's about focus. And that discipline led to some pretty strong targeted wins they highlighted.
Like what?
Well, they secured exclusive distribution rights for IGEL in the UK and Ireland region. That's a big player in endpoint management.
Is that UK Ireland exclusive?
Nice. And then in North America, they added Egnyte. They're a leader in secure content collaboration. So both of these really reinforce their focus on those high growth, higher margin areas.
Which we know are security and data center, right?
Right.
Those continue to be the main engines for the core business.
Exactly. Those are the drivers.
So how does all this, the operational efficiency from the ERP, the vendor discipline, how does that feed into their capital allocation plan, specifically M&A, given that war chest?
Yeah, their plan seems very clear and quite deliberate, actually, sequenced. For this year, the focus is squarely on small strategic acquisitions funded with cash.
Small and cash funded, okay?
Yeah.
Focused on what type of companies?
Specifically targeting services companies. This is a direct play to use some of that financial flexibility gained from the ERP rollout to structurally increase their overall gross margin profile.
Back to that services caveat. They want to push the gross margin permanently above that 5.1% target.
That seems to be the goal. Add services, increase the margin, and also create better vendor stickiness, make themselves harder to displace.
Makes sense. So smaller service-focused deals this year. What about bigger moves?
They address that too. They confirm that the larger, more sizable M&A deals, the ones that could really transform the company's scale, those are penciled in further out. Think 2026, 2027 timeframe.
Okay, so it's a building block approach. Services first, then potentially scale later. And they also declared the dividend, right?
Yep, $1.17 per share dividend declared as well, returning some capital while pursuing growth.
Now let's talk about the competitive landscape and this idea of headroom. Climb's just crossed the $2 billion annual run rate for gross billings. That feels significant.
Oh, that's significant, yeah.
But management keeps saying they're still an extremely small player in this massive market.
Yeah.
They even threw out a number like potential headroom up to $20 billion. Is that realistic?
Well, it definitely raises an eyebrow, doesn't it?
Yeah.
Their perspective is that the total addressable market for IT products and services is just colossal, like $1 to $2 trillion globally.
Okay, sure. It's huge.
And they readily acknowledge the vast gap between their $2 billion run rate and the true giants. The Ingram Micros, the TD Synexes, the Eras of the world. Those guys are doing tens, even hundreds of billions.
Right. Different leagues entirely.
So Climb's thesis is that they operate in specialized high-growth niches. Think complex software, cybersecurity, data center applications, areas where these behemoths maybe aren't as focused or nimble.
So they carve out a profitable niche the giants overlook.
That's the idea. So while $20 billion might sound wildly aspirational today, they believe they have significant runway within those specific verticals before they really start stepping on the giants' toes in a disruptive way.
But isn't there a risk there? I mean, once CLMB proves this high-margin specialized model really works, what stops an Ingram Micro or something similar from just saying, okay, we want that, and throwing their massive scale at those niches to crush CLMB?
That is the constant tension, absolutely. That's the bear case, I suppose.
Yeah.
CLMB's defense, they'd argue, goes back to that disciplined vendor curation we talked about.
The 4 out of 50.
Exactly. By focusing only on those really high-impact, often complex vendors, they aim to become indispensable partners for those specific technologies. They're betting that the complexity and the specialization required in these niches provides a sort of moat against the more generalist giants.
Okay. A specialization mode. Interesting. Let's pivot to the market reaction then, because that tells us how investors processed all this in real time. The stock initially jumped pretty nicely on the earnings release day, right?
It did. Solid spike, plus 4.4% on the day of the call itself. And importantly, it traded on nearly 4 times its average daily volume.
4 times average volume. So
Yeah.
that was pure, unadulterated enthusiasm for that Q2 blowout. Real conviction buying.
Initially, yes, but this raises the important follow-up question.
Yeah.
What happened next?
Because it wasn't just straight up from there.
No. The stock actually saw some significant consolidation the very next trading day, dropped about 5.7%.
So quick reversal after the pop.
Yeah. And for you, the investor watching this, that kind of pullback, even after such a massive beat, it probably shouldn't be too surprising. It often looks like a technical correction, profit-taking perhaps. You have to remember, CLMB has been a stellar multi-quarter performer.
That's true. What's the longer-term return been like?
Over the last year, it's delivered something like a 52% total return. That's absolutely crushed the broader tech indices like the XLK or even the S&P 500. So context matters. It ran up into earnings, popped, and then saw some give back.
Okay, so zoom out, look at the trend. Got it. So looking ahead now to the second half of 2025, what did management signal are the key operational or strategic catalysts we should be watching for to keep this momentum going?
I think there are 3 main things to keep an eye on. First, just the continued benefits flowing from that fully implemented ERP system, more efficiency, more cost savings, driving operating leverage. That's foundational.
Okay, more leverage. What else?
Second, the full impact from their vendor line card expansion. They specifically mention expecting a contribution from Darktrace, the cybersecurity firm, really kicking in during the second half.
Darktrace, right, another key security partner.
And third, and this feels critical based on their commentary, is seeing that targeted cash-funded M&A activity actually happen, watching for those initial tuck-in deals focused on services aimed at structurally lifting that gross margin.
So execution on the services M&A strategy is key for the next phase.
It really feels like it. And, if we try to connect all these dots, stepping back to the bigger picture, well, you've got this extraordinary operational momentum, right? You have clear proof points of efficiency gains from the ERP rollout. You have a pristine balance sheet providing immediate firepower for cash-funded deals.
Right.
And you have management explicitly signaling a disciplined strategy to acquire higher margin service revenue. It kind of feels like the market, maybe even with that post-earnings dip, might still be mispricing CLMB's ability to keep executing this playbook.
Okay, well, that sounds like a perfect setup for our next segment. It's time to put on our slightly more speculative analyst hats. This is not financial advice segment. We need an outrageous but plausible trade idea for a company firing on all cylinders like this.
Okay, all right. How about this? I call it the 2 billion to 10 billion by 27 acceleration play.
Okay, ambitious title. I like it. What's the thesis?
The thesis is actually pretty straightforward, building on everything we just discussed. CLMB has proven it can acquire accretively with DSS. It's proven it can deliver strong double-digit organic growth. And it's proven it can use technology investment, the ERP, to achieve sustainable operating leverage.
Check, check, check.
So the next logical step, based directly on management's explicit commentary, is these tuck-in acquisitions of high-margin services companies. The goal? To permanently push their gross margin profile north of, say, 5.3%, while keeping that tight SG&A control thanks to the ERP.
Right, fundamentally changing the valuation from a distributor to more of a value-added services provider.
Yeah, exactly. That's the potential re-rating story. So the proposed trade idea is essentially a way to buy time for that story to play out. Think maybe a long-dated, perhaps deep-in-the-money call spread expiring out in late 2026.
So using options to get leveraged exposure, but buying enough time for the M&A strategy to bear fruit.
Precisely. It gives management runway almost 2 years to execute on these services acquisitions and prove they can structurally expand those margins. The structure, like a call spread, could help hedge against some of that short-term volatility, like the pullback we saw post-earnings.
Right, defines your risk.
While still capturing significant upside if they successfully execute and the market starts valuing them more richly, the ultimate, maybe audacious target. A market cap that starts pricing CLMB maybe halfway towards the next tier of specialized IT distributors, perhaps in that $5 to $6 billion market cap range, driven entirely by proof of that structural margin expansion from services.
Why? Okay, that's definitely an outrageous but plausible way to play the long game here, focusing on the operational execution and strategic shift. Very interesting.
Again, not financial advice, just connecting the dots.
Absolutely not financial advice. Okay, let's quickly recap the core takeaways from this deep dive then. Climb Global Solutions delivered just a massive financial beat in Q2.
Huge beat.
They demonstrated really strong operational efficiency gains, clearly driven by that ERP rollout, which now seems to be funding the next phase of their strategy.
Yeah, the leverage is real.
And that strategy involves highly disciplined M&A, focused initially on cash-funded services deals to structurally strengthen their value proposition, especially in those high-growth security and data center segments.
That sums it up well. Disciplined execution is the name of the game here.
So maybe a final provocative thought for you, our listener, to chew on.
Okay, here's one. The overall IT distribution market is undeniably vast, right? $1 trillion plus space. But Climb has been brilliantly successful so far by targeting these very specific, high-growth, maybe underserved niches.
Right, their specialization strategy.
So the question is, can that highly selective approach remember advancing only 4 out of 50 potential vendors and their very disciplined M&A strategy? Can that sustain this kind of market outperformance indefinitely? Or will their very success eventually attract the attention of those larger, potentially more competitive disruptors into their specialized segments? That, I think, is the strategic tension to watch as we head towards 2026.
Will success breed competition that erodes their moat? That is a perfect question to leave us mulling over. Great stuff.
Always interesting digging into these.
Indeed. Well, thank you for diving deep with us today. As always, please remember everything discussed here is for informational purposes only. Definitely do your own research and due diligence. We'll catch you in the next deep dive.